On 1st October 2025, the Reserve Bank of India has delivered what economists call a dovish pause. But what does that really mean for you, your investments, and your EMIs? Let's break it down. The Monetary Policy Committee unanimously decided to keep the repo rate unchanged at 5.5%. That's the rate at which banks borrow from the RBI, and it's a key lever that influences everything from home loans to business credit. But here is the twist. While rates remain steady, the RBI has signaled a clear openness to future rate cut. Why? Because the data looks promising. India's GDP growth forecast for FY 2026 has been revised upward from 6.5% to 6.8%. That's a strong vote of confidence in domestic consumption and investment. Even more striking is the inflation forecast, which has been lowered to 2.6%, well below the RBI's 4% target rate. This drop is driven by stable food prices and recent GST rationalization. And that's the dovish signal. Low inflation gives RBI room for cut rates in the future. Let's talk about your money, starting with the equity market. This policy outcome is what investors call a Goldilocks scenario. Not too hot, not too cold. With borrowing costs stable and growth expectations rising, corporate earnings are likely to accelerate. That's a bullish for stocks, especially in rate sensitive sectors like banking, auto, and real estate. If you are investing, consider a buy on dip strategy in consumption driven themes. In the debt market, the sharp drop in inflation suggests that the rate cutting cycle is paused, not over. That's a great news for medium to long duration bond funds. When rates eventually fall, bond prices rise. So, this is a good time to start positioning for that upside, especially if you are looking for stable return over the next few quarters or few years. Now, for home loan borrowers, especially those with a floating rate loan linked to EBLR, that is external benchmark lending rates, your EMIs are staying unchanged for now. But here's the smart move. When rates do fall, don't just reduce your EMI. Instead, reduce your loan tenure. That way, you save more on interest and become debt free faster. And what about gold? With domestic inflation low, gold loses some of its shine as a local hedge. But globally, trade tensions and geopolitical risk continue to support its safe haven appeal. So it's wise to maintain a strategic allocation, especially to guard against rupee depreciation and global shocks. Of course, no policy is risk free. Investors should stay alert to systemic risks like escalating US tariffs, global trade disruptions, and currency volatility. The rupee remains vulnerable to swings in the US dollar. Domestically, the biggest risk is monetary policy uncertainty. If core inflation resurges in Q4 2026, the RBI may delay rate cuts, triggering fresh volatility in both debt and equity markets. In summary, the RBI has struck a delicate balance supporting growth while keeping its options open. For investors, this is a moment to stay informed, stay nimble, and prepare for a rate cutting cycle that's likely just around the corner. Want help aligning your portfolio with this micro shift? Let's decode it together. Schedule a meeting through the link mentioned in the description.